we get our arms around this frustrating moment? Right now, the stock market's like a chemotherapy patient. We've got a cancer. It's called inflation, and the Federal Reserve is trying to kill the cancer desperately. But Dr. Powell's treatments also hurt the economy. We're hoping that the Fed can contain inflation before the economy heals over. And the diagnosis has gotten better in the last couple of months with commodity inflation collapsing, retail gluts all over the place, as Nordstrom said this very evening. But in the end, we don't know how aggressive the Fed will be going forward, which makes it hard to figure out where this market's ultimately headed. At times like this, I find when the fundamentals are this murky, I like to fall back on technical analysis. That's why tonight we're going off the charts with someone new. With the help of Ralph Vince, he's a brilliant technician who's been programming trading systems for all sorts of funds since the early 80s and has an incredible grasp of the big picture. Just as important, he was personally recommended by Larry Williams, the godfather of market historians, who's done so well for us in Mad Money. Right now, Vince feels relatively good about the market. He sees it drifting gradually higher. He'd be a buyer in the weakness. However, he's also noticed some ugly cross currents that you need to keep an eye on. If they worsen, he'd be inclined to change his views. So I want to expose you to all his different thoughts because I think that they are so important. Let's start with employment, because this is, of course, the number one driver of any given bull market. The employment to stock prices correlation is incredibly strong. There are a lot of different ways of measuring the elephant that is employment, but Vince likes to look at continuing jobless claims. Unlike the monthly labor report, we get jobless claims every week. So the data is timely. And when you look at continuous jobless claims in particular, they aren't subject to insane revisions down the road. This chart shows continuing jobless claims going back to the 1980, with Vince's risk on or off model overlaid in blue. His model says you go long the stock market when the 39-week continuing jobless claims make a new low, and you've got to go negative when continuing jobless claims start making new highs. Using this buy-or-sell trigger has been very accurate for the last 42 years. In fact, going back to 1980, it's batting 1,000. Since 1980, it's identified these short to long switches, or vice versa, on the S&P 14 times. And do you know that it's been right every single time? Even as there are moments, well, that it makes you nervous. Right now, Vince says the continuing claims data remains in bull mode. Even though we're very worried about a Fed-mandated recession, we've got an insanely strong labor market here. That's good news for the broader economy, even if it makes the Fed more likely to raise rates aggressively down the road. But this stubbornly resilient job market also offsets some of the damage from these rate hikes. Of course, employment is not the be-all and end-all. You also got to keep an eye on earnings and dividends and the market's overall valuation. So I want you to check out this chart of the S&P 500 overlaid with Vince's valuation model. He looks at the S&P's earning yield, that's the 12-month trailing earnings per share, divided by the share price, basically the price to earnings multiple reverse, along with the dividend yield. Then he compares them to the yield you'd get from 90-day Treasury bills. Going back to 1980, Vince's valuation model is fired off a buy 18 times. And while it's not perfect, it's been right 16 times out of 18. I regard that as pretty darn accurate. Plus, as you can see, his valuation model would have kept you out of the crash of 87 and the dot-com collapse and the financial crisis. That's pretty darn good. Well, it kept you out of the internet boom in the late 90s where you could have made a lot of money. Other than that, I'm calling this thing pretty darn reliable. More importantly, right now, this valuation model says the market remains a buy. It's in risk-on mode, so to speak. But, and this is a very big but, kind of a Sir Mix-a-Lot but if you want to get graphic, what's driving Vince crazy is that we've also got some disturbing big-picture negatives. So check out this chart, which shows both the S&P 500 and the inflation-adjusted earnings per share of the S&P's components going back to 1880. Right now, Vince points out that inflation-adjusted earnings have gone negative this year. Historically speaking, that is a bad sign. In fact, going back to World War II, inflation-adjusted earnings going negative has always spelled trouble for the stock market, even in the 87 crash, which was mostly about the market getting overheated. We briefly saw the inflation-adjusted earnings for the S&P go negative a few months before that meltdown. So this is not good. As for right now, this is not some blip. Vince notes that inflation-adjusted earnings have been negative for a big chunk of the year. Makes sense. Inflation is ridiculously high and corporate earnings growth has taken a hit. While some of his other models are positive on the market here, this inflation-adjusted earnings signal, I'm calling it ominous. Let me give you one more. Take a look at this chart of dividend payouts per share in light blue, plotted next to the S&P 500 in dark navy, going back a few years. Historically, dividends per share have tracked very strongly with the broader stock market. Companies boost their payouts when times are good and cut them when times are bad. So they're an extremely tight correlation. Not long ago, Vince points out that dividends per share turned positive after briefly going lower, and these switches can often stay positive for a protracted period of time. That's a good sign for the market. On the other hand, Vince doesn't like what he's seeing in terms of margin balances or overall economic activity or even the market's breadth. But when he looks at the positives, especially employment, he thinks this market can keep drifting higher in the next several months. So one major caveat, while things are okay now, they could go south in a hurry, which is why Vince is watching the percentage of new lows on any given decline. If that percentage goes above 4% of total issues during a high-volume decline, then he says you need to get out. But that hasn't happened yet, and we really haven't gotten close. Not even yesterday when the action was pretty ugly. Without that, he says any pullbacks, they're buying opportunities. The bottom line, the charts as interpreted by a man named Ralph Vince, whom we really like, suggests that this market can keep drifting higher for the next few months as long as employment stays strong. Please don't get too complacent, as there are signs that not all is well as we go into the final third of the year. Can we start with Victor in California? Victor.
Jimmy Chill, it's such a pleasure to talk to you. I want to thank you for being the champion of retail investors, my friend.
That's what I want to be. Thank you.
Absolutely. And because of you, I've decided to buy more GameStop and Bed Bath & Beyond. Shorts never closed. Boom.
Not really, but that's all right. Let's go to Alex in Oregon. Alex.
Monsignor Cramer,
yes.
We miss the notoriety of having your daughter live in our state.
Well, she might be back someday. She truly loves it. Good to hear from you again. What's going on?
Hey, can you help me with Twilio? I've had it high, I've had it low, and it's at a 52-week low. Can you give me some direction there?
Yeah, until, as much as I like Jeff Lawson, I love the product, until they start actually making real GAAP money, actual earnings, I think that Twilio is going to remain, let's just say, undervalued, but not to go higher. And I thank you for the kind words about me and my daughter. Let's go to Tom in Louisiana. Tom.
Hey, Jen. Good afternoon.
Good afternoon.
About SoFi, S-O-F-I.
SoFi is too cheap at 6. I don't know when it's going to turn. I know a lot of people feel that it's down 60% and therefore it's a loser and they're going to be selling it until the end of the year. But I myself think that SoFi is too cheap to sell. Okay, the chart suggests that this market can drift higher for the next few months as long as employment stays strong, and that's the key thing. But let's caveat it by taking some caution into the realm. Much more in Moneyhead, including I've done my homework on Atcor, and I'm ready to turn in my research on the stock that you asked about. And every morning I wake up very early and notice one shocking pattern. I'll reveal what it is and how you can position your thinking to fight it. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.